Today, we're going to look at 3 steps a business owner can take to get a whole life insurance policy that fits his situation perfectly. So we've got a business owner who is interested in a whole life insurance policy. The goal is cash value, and he wants to use it for his business. Specifically, he wants to build cash value so he can finance new projects. He owns a construction company. Now, he's worked with banks for years and he wants to break away from them. He feels like working with a bank is distracting, and also having a loan stresses him out. Also, regarding putting money into a policy, he doesn't want to be on the hook for a big premium every year. So he's expressed that he'd like to be able to move a total of $500,000 into his whole life insurance policy. What he'd like to do is this over 5 years in equal payments of $100,000 per year. But again, he doesn't want to be on the hook for that amount every year. So how can he have the option to fund $100K, but not be committed to paying that much? And then he wants to see exactly what the policy will look like if he takes loans, repays it, and he wants to know what the true cost to borrow is versus the true growth rate on the policy. So I'll break things down into 3 steps, and I'll show you exactly what I would do for someone in a situation like this. So here we've got our business owner looking to fund $100K per year for 5 years. Step 1, I would prioritize cash value. I would not accept a policy with lower cash value than what the policy could otherwise have, because that's where people have buyer's remorse. And also, if I plan on using this for my business, if I'm going to take less cash value up front, that is a lost opportunity cost no matter how you slice it. So how I would prioritize cash value is if his desired payment is $100K per year, I would minimize the premium as low as the insurance company will allow, which is about 10%. That's what I see with the major mutual companies. You can get it a little bit lower in some cases, but just to keep this example simple, we'll say 10%. Then the rest, I would allocate toward his PUA rider. That'd be the other $90,000. PUA stands for paid up additions. I like to call this a cash dumping. The next step, I would make the policy very flexible. He expressed that he does not want to be on the hook for a big premium bill every year. Well, you're committed to whatever your premium is. Your PUAs are flexible. Some insurance companies allow you to add PUAs 100% at your discretion. For example, if you look at the 4 major mutual companies, which I like all of them, if you take Guardian though, for example, they're a company that will allow you to commit just to the minimum premium of $10,000 in this case, and then the other $90,000 of PUAs could be added 100% at your leisure. So what that means is literally he can set it up where he is billed for $10,000 per year. That's all he's obligated to pay. And then he can just dump PUAs up to an extra $90K whenever he wants. And if he doesn't get the full $100K in every year, his cash value will be less than what we see on the illustration, but that's okay, we would model that. However, this just illustrates the flexibility. So it takes away the thought of, oh my goodness, I've got to pay $100,000 every single year. What happens if I can't pay it on my due date? Some companies are not that flexible and you would need to pay it on your due date or make some adjustments. But step 2, making it very flexible. And step 3, looking at the net cost to borrow. And this is pretty simple. I want to see what my true cash value growth is on a year-to-year basis. Then I want to see my loan interest cost. And I just want to make sure that the cash value growth is greater than the loan interest. And if it's not, I want to see it. This way, I don't have a nasty surprise where I thought I was earning more than what I'm actually getting and I'm running a loss. That's where people get upset. Naturally, because it's their money we're dealing with here. So here's our illustration. Step 1, we want to prioritize cash value. So we've got $100K going in. Here's your premium at 10%. The true base premium is actually a bit less than 10%, but I just rounded off the base plus the term is close to a 10% minimum. Then you've got 90% going toward your PUA rider. Add the two together, there's your 100K. First year cash value, very rich at about 92%. That's still the drawback though, where you take that first year hit. Now, when you look at 100K going in every year, by the third year, you've paid in a total of 300K and you have almost 300K. So your break-even point is very close to year 3, and then you're cash positive in year 4. That's your true break-even in this example. Now, his plan is to fund it for 5 years. We'll get a total of 500 grand in and then stop, but he can keep adding if he wanted to. So if he changes his mind and says, hey, can I keep adding 100K, or I want to pay 20 or 30K, you can easily set up a policy to do that. It's not difficult at all. If you'd like to see how, I would check out some of our design videos. But with that said, we're going to stick to this plan of wanting to stop after 5 years. You will notice after the 7th year, the death benefit drops here. We're reducing that to reduce costs. You can drop the death benefit as early as year 8 without triggering what is called a modified endowment contract, or MEC, which is a taxable event with a life insurance policy, which we don't want. And also to recap step 2, this policy is made very flexible, as we can set it up where we're only obligated to pay the premium, and then the PUAs can fluctuate each year. So we're not on the hook to pay 100K every year. Okay, let's progress on to step 3, which is using the money. So with policy loans, his plan is to model a $250,000 loan and pay it back just like he would pay it back to the bank. So before we look at the loan payments, the first thing I want to do is look at the cash value and death benefit before that loan. There we go. And then after we take the loan, your cash value drops. Your cash value is your line of credit. Think of it as your equity, or how much you have access to. And then your death benefit is collateralized dollar for dollar by the amount you borrow. So we see both the cash value and death benefit drop when he takes that $250K loan. He begins to repay it at $2,500 per month. In light blue, we have his payments. We can see how much is applied to interest and how much is applied to principal. But when the loan is paid back, what do you notice? There's your cash value and death benefit. And if we compare that to the example where we just let it sit and grow, everything's exactly the same. So even though you had that loan outstanding, your money continued to compound as if you never touched it in the first place. You get the constant compounding. Let's look at the net cost, because this was really step 3 with respect to what he wanted to see. So what we've got is the cash value growth. This is showing what his cash value is growing by year over year net. For example, year 1, he puts in 100, he's got 92. That's why he's got the $8,000 loss. Year 2, he was at 91, he added 100, he's at 190. That's why he's got the $1,000 loss. And then year 3, he's at 190, he adds 100, he's at 297. That's why you see growth of about $7,000 that year. But then, when we look at the growth, we also want to factor in the interest, the loan interest we're paying. And here we go. We've got it side by side. And then we can look at the difference, which is really just your spread. When I take my growth and subtract the interest that I've paid, am I positive or negative? And he is negative for 1 year in this case. Very important to see that before you take loans, isn't it? It definitely is. So to recap, what are the 3 steps? Step 1, I would prioritize cash value. Step 2, I would make the policy very flexible. How you accomplish step 1 and 2 is by reducing the premium as low as the insurance company will allow. You'll see most of the 4 major mutual companies allow a 10% minimum. Some are a little bit lower, like Mass Mutual actually lets you go a bit lower than that now, which is nice. But I would reduce that premium as low as I can, and then I would want to know the PUA flexibility rules with different insurance companies. This way I can set it up if I wanted to, or I'm only billed for the minimum, and I can throw in PUAs at my discretion. And then step 3, look at the net cost to borrow. What am I earning? What am I paying? And have awareness of that number. I hope you enjoyed this video. Please let me know your thoughts. If you'd like to see more videos like this, let me know in the comments below. And as always, I hope this helps.